right, everyone. It's 4 p.m. We're not late, unlike other people. So give me one moment and please read this. I am not a financial advisor. I am not a registered investment professional. Please take everything I say with a grain of salt. Let's make that a little, let's make it a little bigger. I guess I can't make it bigger, but if you please pause this and read this disclaimer, I would appreciate it. Please do your own due diligence. Take everything I say with a grain of salt. So, Nvidia, I am actually shocked that it finished where it did for the week. So let's bring up a chart of good old Nvidia, which put up what is, in my opinion, the greatest quarter that I have ever seen. The fact that it's down 4.1% or 4.71% is crazy to me. So let's remove the disclaimer. Let's add this. I mean, this was an incredible earnings. And I think I'm going to do Sunday streams more. We're going to do Sunday coffee and stocks. I'll probably pick one stock a week to go through. It is, maybe we'll do more than one. We'll see how it goes. Maybe I'll even take suggestions on what to discuss. But this week, Nvidia is what I am planning on talking about. And the fact that it is under 180 is flat out shocking to me. It reached just over 195 and then fell to, can't believe it fell to almost one. I think at one point it was 170 or just below it. And the fact that we finished down almost 5% this week after these earnings was incredible. So I have my notes here, and then I'm going to get into all the numbers I put together for everybody. So $57 billion in revenue, up 22% quarter over quarter and 63% year over year. When you think about the amount of revenue that Nvidia does, to grow at that rate, to put up the same year over year revenue increase as Palantir, when Palantir is a much smaller company, absolutely incredible to me. 31.9 billion net income, 56% net margin. I mean, gross margins, 73 to 74%. Absolutely incredible. Now, the growth is coming from the data centers. We all know this. Data center revenue hit 51.2 billion, which was roughly 90% of Nvidia's sales. Data centers grew 25% quarter over quarter, 66% year over year. We know that there is a lot of Capex being spent. The big question is, when is it going to slow down? If you saw last night, Chris and I discussed cyclicality, when we expect it to become a cyclical market. We have had a difference of opinion on this over the past couple of years. At some point, I do believe he is going to be correct. At some point, I completely foresee this becoming a DRAM cycle type thing. I don't think that that's going to be for quite some time. So we'll see what happens. Now, 53 billion of the data center revenue came from compute and about 8.2 billion from networking, which was up 162% year over year, which is really interesting to me. Now, Nvidia's got an incredible balance sheet. They returned 37 billion to shareholders through buybacks and dividends over the first 9 months. They still have 62 billion left on the repurchase authorization. I actually think we're going to see big purchases in Q4, considering where shares are right now. And they have 60 billion in cash on hand. So, pretty healthy balance sheet. What may be the most incredible portion of this was that Nvidia guided for 65 billion in Q4 revenue. So when you think about that, you're at a 230 billion run rate. You are at a 50% net income margin, talking about a company the guy's going to put up 115 billion in net income roughly. I mean, this is absolutely incredible. The fact that they are operating at more than a 50% margin. Now, we all know Michael Burry came out with all this stuff. I didn't get the opportunity to read something last night. I'm going to read it right now. So, look, I am not an accountant, but I have friends who are CPAs. I'm going to paraphrase what my buddy sent to me. So give me one moment. Let me take a sip of coffee, and I'm going to get through this. So I had asked him if he could do me a favor and look at the depreciation. Exactly what I said to him is, can you do me a favor? Can you go through NVIDIA's numbers and tell me if there's a depreciation issue? This is what he came back to me with. I think Burry is just a moron when it comes to his arguments surrounding depreciation. His whole thing is he wants the asset to be depreciated on an accelerated basis because of how fast the technology evolves. But then wouldn't the same have to be true across the board for any electronic equipment, from laptops to phones to computers, et cetera, et cetera? Then he goes in to say, so for Burry to come out and say that the depreciation on GPUs should be, say, 2 to 3 years, now you're talking about modifying tax standards. I don't think NVIDIA is doing anything wrong. This is just a bare case of, quote, I am right and you are wrong, end quote. But they're doing it by the book and standards. So until they come out with new standard for depreciating assets, his argument is simply bullshit. All right, so I don't know if my buddy's right. I don't know if Burry's right. I'm going to lean with my buddy who I know what his background is. And I got to say, I will trust him with his background over Burry's freaking bare argument about NVIDIA's depreciation schedule. So I said that earlier in the week that I think it's a bullshit argument. So I'm glad that at least somebody who I trust in the finance space from an auditing perspective feels the same way. So I really like that. Now, look, NVIDIA is still the king of AI. There's no question about this. And I'm excited for Rubin. I'm excited for all the future sales of Blackwell and Blackwell Ultra. And data center revenue grew by 10 billion in just one quarter. That shows you how fast the customers are standardizing their platforms. And as they become more ingrained with CUDA and software, I think NVIDIA is going to have a shoe-in for reoccurring revenue from a software side, kind of like what Cisco did, which is very interesting. And they're already talking about next-gen Rubin chips, and they're saying that they have huge amounts of pre-orders lined up. So we have a roadmap of years, not months. So I saw, just like everybody else, what happened when they introduced Blackwell and they went to the Blackwell line. We know from what Jensen said, and we know from what all the CEOs said on conference calls, 2026 is going to be a big year for spending. Now, the question is, does that continue into 2027? Maybe. I can't answer that. I can only tell you that I think it's going to from what I am seeing, but nobody has a crystal ball. This could go into maintenance mode. We really have no idea. So you got to keep that in mind that nobody knows. We don't even know what's going to happen next year. All we can do is go off the data that we have in front of us. And the data we have in front of us is what Jensen said, what NVIDIA reported, and what was said on the conference calls of Amazon, Meta, Microsoft, and Alphabet. So I think that there is an ecosystem moat with CUDA. I think that they're going to monetize that. And I think there's a deep integration with hyperscalers. So I'm really excited about this. So let's go into some numbers. All right. Then I actually found a few videos that are interesting that I want to look at. So we're going to go straight down the line, and we're going to go through a lot of the analytics that I put in my Seeking Alpha article over the week. I think it came out on Friday. So give me 1 sec. I actually want to move a few things around on my screen so it looks like I'm actually looking at the camera. All right. All right, everybody can pretty much see this. So we know that the four biggest customers of NVIDIA is Alphabet, Microsoft, Amazon, Meta. So that's who I'm going to focus on. So the top is the TTM, cash from operations, and free cash flow. I hid Capex because I needed the space. But free cash flow is simply cash from operations minus Capex. And when you look at how much free cash flow these companies are still producing, the four of them are still producing over 200 billion in free cash flow. So there's no Capex problem here whatsoever. These companies also have the strongest balance sheets. So really not worried about it. From a Capex allocation story, in 2024, they generated $217 billion of Capex spend. That's crazy. What's even crazier is it was a year-over-year increase of 55%, and they spent $77 billion more on Capex. In the TTM, they have spent $330 billion on Capex, 52% year-over-year increase, as they spent an additional $112.49 billion. Now, Microsoft has a different fiscal year than the rest, so you will see Microsoft's number different in the TTM than 2025 expected because their 2025 fiscal year actually ended in Q2. So this is their number. When we look at where everybody expects to land for their 2025 fiscal years, they will have spent $354 billion on Capex. And that is a $137 billion year-over-year increase from 2024. They will have spent an additional 63%. Think about that for a minute. Increasing Capex by 63%, and we know that these companies are expecting to spend more next year. This is why I think it's very important. And this is one of my favorite charts because Apple, over the past 5 years, has only allocated $55 billion toward Capex. Now, I think everybody knows where I stand on this, that I think it's a mistake that they have not been investing in themselves through Capex. But you know what? I'm not Tim Cook. I'm not running the company. But we can see clearly Meta, Microsoft, and Alphabet have all spent between 170 and 220 billion. Now, Amazon is the big one, but keep in mind they have a huge logistical network that they need to allocate capital toward. So their Capex number is always going to be bigger, in my opinion. Now, some would say, as the bears, this is egregious, this is too much, blah, 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 blah. Well, is it? Is it too much? I say no. Here's why I say no. When you look at revenue growth, because everybody wants to talk about growth, whether it's EPS or revenue growth, that's what people want to talk about. That's what people want to capture in their investments. We'll make this a little bigger for everybody. So Apple, and you remember the chart I put together in the previous slide, they have underinvested in Capex compared to everybody else. Their revenue has only grown by 14% over the past 4 years. Microsoft and Meta have grown by more than 60%. Amazon and Alphabet more than 45%. There is a clear correlation between Capex allocation and revenue growth. And even more importantly, the cash from operations growth, because that's the cash your business is generating from its services and products. Apple's cash from operations has only increased 7.16% over the past 4 years. It's gone from 104 to 111.5 billion, 7.44 billion growth over a 4-year period. Look, a lot of people are not going to complain with that because it's 7.44 billion in growth. A lot of companies don't produce that in a year, but that's not the crux of the argument for the bears. And I believe that this is the crux of my argument about why they're wrong, because the investment in Capex has allowed Microsoft to grow their cash from operations by 65% over the past 4 years. They've gone from 89 to $147 billion of cash from operations. Now, keep in mind, Amazon, oh my God, too many A's. I am sorry. Apple was the only one in 2021 that was exceeding 100 billion in cash from operations. Now, in the TTM, they're all exceeding 100 billion. And Apple is doing less than Microsoft, less than Alphabet, and less than Amazon. And Meta is right on their heels, and they may even surpass them next quarter, maybe in 2026. We'll see. But they're right there also. And you cannot discount that Alphabet and Microsoft have grown their cash from ops by over 65% over 4 years, Meta 86%, Amazon over 182%. There is a clear correlation to this. And then we look at margins. Apple's running a 27% margin, cash from ops divided into revenue. Microsoft is over 50%, and so is Meta. Alphabet is almost at 40%. Even Amazon is close to 20%. And Amazon has a huge logistical network and huge e-commerce business. I mean, Apple's margins have gone down, whereas Microsoft's have pretty much stayed flat. Alphabet's gone up, Meta's certainly gone up, and Amazon's gone up. So not only are they growing at a snail's pace compared to these other four, their margins are compressing. I mean, to me, this is huge because it shows you these companies that are spending to invest in themselves are expanding revenue and are expanding cash from operations. So the idea that Capex allocation is outstripping the growth, I'm calling bullshit on it because you're seeing huge growth that would not be here if these companies were not investing in themselves. And as a shareholder of now all five of these, okay, I just became a Microsoft shareholder for the first time in my life last week. So I can happily say I no longer have to exclude Microsoft from these statements. And I can say, as a shareholder of these five companies, I am thrilled they are investing in themselves because of the results that they are showing. And I think that the valuations are absolutely crazy now. And when I look at, now let's take, hold on, give me one sec. Get rid of the arrows. Okay, everybody can see this good. Look, Nvidia's 2027 EPS, where my mouse is right here, was, I believe, $8.07 heading into earnings. After earnings, it jumped to $8.68. And after earnings the next day, the street has $9.43 for their 2027 EPS. So when I look at this, and I look at Nvidia at 18.97 times forward earnings, and they have over 100% EPS growth over the next 2 years, it looks very attractive to me. I mean, think about it. Tesla has 98% expected EPS growth, and they're trading at 119 times forward earnings. I mean, does that even make sense when Nvidia is more EPS growth and trading at a sixth at this point valuation? Doesn't make any sense. It doesn't make any sense that Nvidia is trading at a lower multiple than Coca-Cola. It doesn't make any sense they're trading at a lower multiple than Walmart or Costco. And quite honestly, I don't think this is an expensive market. I think that a lot of companies that didn't deserve to be where they were got hit. I think that they don't matter to the S&P because they're not in the S&P. Some companies, such as Palantir, that are in the S&P, they got hit. Oh, well, everybody's still up a tremendous amount because most people were buying Palantir under $20. And when it comes to the companies that are the largest components of the indexes, I think they're trading at good valuations. I can't even make an argument against Apple at under 30 times when you have Walmart and Costco trading over 30 times. I'd rather own Apple than the two of them. I don't know about you guys, but that's just me. And when I see Amazon and Microsoft and Alphabet trading at under 25 times forward earnings, and then I see Nvidia and Meta under 20 times, this looks like a market that's got a lot of legs. I threw Netflix and Broadcom in there. They both trade under 30 times with a lot of forward growth. So I think Nvidia is extremely interesting here. And if I did not have a full position, I would probably still be adding to it. For me to continue adding, I think it would need to fall to about 160 or so, which I don't think is going to happen, but it could. It could go lower. Now, when I look at margins, it gets really interesting. And I threw up a bunch of companies, and NVIDIA is right here. They're the largest one in the group. But this is certainly not operating like a hardware company. I mean, a 58.8% operating margin, EBITDA margin of over 60%. So out of Alphabet, Microsoft, Amazon, Broadcom, Meta, Walmart, and Costco, largest operating margin, largest EBITDA margin, cash from operations margin is in third place at 44%. Free cash flow margin is second place. Net income margin, first place. They have a net income margin on the trailing 12 months of 53%. Now, when I look at NVIDIA versus Broadcom and AMD, okay, net income, slaughtering both of them. Free cash flow, cash from operations, slaughtering both of them. Operating income, leaps and bounds ahead. EBITDA leaps and bounds ahead. And on a margin basis, Broadcom and AMD are not touching NVIDIA. They're just not. And when I look at this on a forward basis, obviously we looked at it before, very inexpensive, but I look at it on a current basis. Compared to these companies, the price to EBITDA for NVIDIA is just under 40 times. You don't have that with Broadcom or AMD. Price to operating income, price to cash from ops. I mean, these are attractive considering the margins and consider NVIDIA's growth rate. And then on a pure profitability level, NVIDIA is trading at just under 44 times current profitability. And they do have the ability to double their profitability over the next 2 years. And when I see Broadcom and AMD at 84 or call it 85 and then 100 times profitability, and I look at these margins and I look at NVIDIA's growth rate, I got to tell you, NVIDIA looks really freaking interesting. So I think Burry's wrong. I think the Bears are wrong. And I think NVIDIA is still in the driver's seat. I think that we're going to need a lot more Capex spend. I think we're going to need a lot more data centers. And I am really excited for the future. And I'm glad I was buying NVIDIA when I was buying it. I'm glad that I built the position out. And I am excited to hold it. Now, that doesn't mean my investment thesis won't change. If the data changes, I will happily exit my position in NVIDIA. But ever since I became bullish on NVIDIA, and look, I'm going to give Tanner Future Investing a lot of credit here. He's been long on NVIDIA for a very long time. And I would argue with him that it was very overvalued. And I felt it was overvalued before the ChatGPT moment because they had no growth. There was a year where the year-over-year growth was nothing. And then when ChatGPT happened and all these companies started accelerating their CapEx spend and NVIDIA's numbers changed, I went from being a non-believer to a believer. Now I can go back to being a non-believer or neutral as I've gone neutral on Apple if the data changes. But I do think that we're in a position where we're going to have at least a year, maybe closer to 2 or 3 years of foot on the gas expansion The big thing is conference calls. And I don't think the Bears spend a lot of time on actually looking through the conference calls and listening to them. Nobody will convince me that the combination of, take Jensen out of it, okay? Take the CEO of Nvidia out of it. When you have Nadella from Microsoft, Sundar from Alphabet, Jassy from Amazon, and Zuck from Meta, and then you throw Elon in there and you throw Altman in there, you have these CEOs telling you that they can't get enough supply. You could throw Larry Ellison in there. I mean, these are the people who have built, except for OpenAI and Oracle, trillion-dollar businesses. Like, they have scaled trillion-dollar businesses. How are we going to say that the people that have scaled the largest companies in the world are wrong? If this was just a fantasy project with Zuckerberg with the metaverse, you wouldn't hear me talking like this. And I would say, yeah, this is probably crazy that Meta is spending the money, but at the same time, I'm not against Meta spending the money because Zuck has earned that right, in my opinion. But that's not the case. The bottom line is every one of these companies is spending the money. Every one of these companies is aligning their future businesses toward this. So think about that. You have Oracle, OpenAI, I guess the combination of XAI, Tesla, and whatever you want to say with Elon, and then Amazon, Alphabet, which is Google, YouTube, and all the subsidiaries, Microsoft, and Meta Platforms. So the Bears actually want to get people to believe that the combination of those companies don't know what they're doing. Okay? I find that hard to believe. Like, I really find that hard to believe that people on the sidelines are going to sit there and say that don't work for these businesses and may not even be in the industry that these guys are wrong. I'm not buying it. It's crazy. So when we have the biggest CEOs and the biggest companies telling us where everything is going, and then you have just Amazon, Alphabet, and Microsoft tell us that 755 billion in cloud backlog exists for them, that's a lot of backlog. And the only way that backlog is going to get filled is if there's more data centers and more cloud infrastructure. You don't get that without spending. So I got to tell you, I do think that we're in a good position. And I'm also thinking about like this. What happens after? Do we just go in maintenance mode? Or does Capex come down? I can't answer that. But if we go in maintenance mode, they're still going to have to spend to maintain and replace chips. So the spend is not going to disappear. Now, maybe it goes down, and that would probably hurt Nvidia. But I also think that there is an adjacent play here. Companies like Eden, natural gas companies for pipelines, such as Energy Transfer. I think that there are very interesting things adjacent that will continuously do well. I mean, look, we know we're going to need a lot more electricity and a lot more natural gas. So I think utilities will do well. Now, utilities have their own set of problems due to the debt load, due to rates, and obviously technological breakthroughs. So something may be able to disrupt them. I think it's a low probability, but maybe. At the very least, we're going to need more natural gas, and I think pipeline companies will do well. So I think there are interesting plays. But as far as Nvidia goes, I don't think this party's stopping anytime soon. I think it's going to keep going. The fact that Jensen said 65 billion for Q4, and then when I look at where they've been and what their growth rates have been, I mean, that makes me think that, man, 2026 is going to be freaking crazy. So I actually did not get a chance to watch two videos, and I want to share them. So one of them is NVIDIA reignites chip depreciation debate. It's a very short clip from CNBC. I want to listen to this and see what their stance is on this. I'm going to try to not make the rookie mistake and share it with.
Years AI chips are actually useful adding some fuel to those bubble fears. Nvidia CFO weighed in on that last night, saying that chips they shipped 6 years ago are still fully utilized today. It's a good topic for our Deirdre Bosa in today's Tech Check. Hey, Dee.
Hey, good morning, Carl. So that's right. CFO Colette Kress, she tried to put the depreciation debate to bed, but she may have actually raised even bigger questions. She essentially said that Nvidia chips, they last longer than most people assume, 6 years, and still at full utilization thanks to its CUDA software. But what does full utilization actually mean? Running isn't the same as creating economic value, and that is where Michael Burry comes back in, throwing cold water on the whole idea. He posted on X that extending useful life confuses physical utilization with value creation. He likens the A100 chips to airlines that keep old planes around for holiday overflow. Yes, they fly and they're full, but they're only marginally profitable, and they're not worth very much at all. Now, Jensen Huang has basically admitted this. He said last March that you can keep old GPUs working, but they become almost impossible to sell once the next model shows up. This was at GTC. He said that Blackwell, its latest generation, is so much more powerful than Hopper, the previous generation, that, quote, you couldn't give Hoppers away. He said there's only a few circumstances where they're even fine. That's the word he used, fine. Now, in the current moment where supply is tight, old chips, they will get used. But if that imbalance changes, and this is sort of the question on everyone's minds, does that value drop very quickly as well? The risk for investors is this uncertainty. If you do not know how long these chips stay economically valuable, you cannot properly model Capex or margins. You can't model the AI cycle with confidence. Meanwhile, guys, I know we talked about Google's TPUs yesterday as a longer-term alternative to NVIDIA GPUs. If the market is struggling to understand the economic life of NVIDIA hardware, Google's bet is just to build its own. It just dropped Nano Banana Pro this morning, its new image model, powered by Gemini 3, which runs on TPUs, not GPU infrastructure. Investors, they continue to pile into this trade, this vertical integration story. Google shares still up nearly 1% today as the tech trade overall sort of softens.
Yeah, that's a great example. But you're right, the conversation is not going away. It's definitely feeding the short discussion. And that's not even mentioning some of the innovation that we're getting out of the likes of China, which continue to be just a series of like deep seek echoes, although not as noticed now.
One of my favorite topics and biggest questions amid all of this, how do the Chinese get away with spending like so much less than American model builders? I mean, it's like a 9-to-1 ratio. We're spending on GPUs, on all of this infrastructure, and the Chinese are able to create comparable open source models, in some cases, beating on some benchmarks. How does that all sort of pan out? And that's another bigger question for sort of the bubble anxieties that I think is only going to get louder and raises questions also about the GPU usage.
For sure. Deirdre, thank you. Deirdre.
The only Mag 7 stock positive on the week, and its renewed AI momentum is worrying one of Google's biggest AI rivals, according to new reporting. Deirdre Bosa has more in today's Tech Check. Tell us all about it, Dee.
This is a good one, Contessa. So according to a memo obtained by The Information, Sam Altman told his employees that he expects, quote, the vibes to be rough out there for a bit, as Google's recent progress could create some temporary economic headwinds for them. Now, that line, temporary economic headwinds, it gets at this emerging narrative in the AI race, hype versus hard economics. And Google's numbers, they are first in class. Gross margin of 32%, cash reserves $112 billion, free cash flow over the last quarter, $24 billion. Now, OpenAI, on the other hand, isn't even profitable. It's burning cash fast, and it has to raise again and again just to keep pace with a company that can fund its entire AI strategy out of search profits. Put another way, if I need to, Google can weather a downturn, but the bubble bursting or even maybe deflating could be existential for Altman and OpenAI. So when you hear Google's leaders, Contessa, start talking about a bubble this week, like
I do want to say this about OpenAI. Look, what they've done is incredible, but when I think about Alphabet / Google, OpenAI should be worried. Think about it. Alphabet has the world's data at its hands from Google search and YouTube. Those are two biggest search engines. They also have unlimited cash. because they're generating the most amount of cash from operations and profitability next to Microsoft. So they have YouTube, they got search, they got Gmail, they got Maps, they got Android, they got Waymo, services. I mean, they have an unlimited checkbook. They're widely profitable. No other company has that combo of assets, nor do they have that combo of data. Now, OpenAI is projected. I mean, look, they're not a public company, so take the numbers I'm saying with a grain of salt because I'm regurgitating what I've heard people say in interviews. But if memory serves me correctly, they're expected to lose around $7 billion by 2028, and they're burning roughly $8 to $9 billion a year trying to compete, and they're being valued at $500 billion on around $13 billion revenue. I mean, Alphabet trades at a lower multiple on revenue than OpenAI. They're incredibly profitable, and they're not burning cash. And I believe Alphabet has close to $100 billion in cash on hand. So I do think that Altman has a lot of reasons to be worried.
We have from Senator Pichai and Demis Hassabis. You got to wonder who that really hurts and who it could help, but a very interesting change and dynamic over the last few months.
And the other interesting thing, and we had briefly touched on this yesterday, Dee, when we were talking, is that Google has a lot of experience in consumer-facing products. And so the idea that you would be able to use your AI in a way that is accessible to people, whether they're small business owners or factory workers or entrepreneurs or just, you know, my mom, that they would be able to give those products in a way that's accessible.
You're hitting at really the core of the bull thesis around Google right now, and that is the full stack. It has the distribution, the ecosystem, the chips, the models, the products. I mean, even with the Gemini 3 release this week, they didn't just release it to subscribers or to people who are looking for AI chatbots. They released it across AI mode. So that's potentially billions of users who aren't even necessarily looking for a chatbot. They're getting the power of, you know, the best model out there right now. So even your mom, who's maybe using a ChatGPT, a Gemini, I don't know if she's using a number of them. I told my mom that she has to. She might be using, you know, Gemini 3 and thinking this is the best one. And then that may be sticky because she's using Google or she's trained on Google. So certainly flexing that. And it's funny to go back to Contessa, you know, Satya Nadella's comments from not all that long ago saying that he wanted to make Google dance. They're dancing, and I think they're having fun doing it.
Well, I agree with what they just said in that interview. In the first interview, I still think you have gap accounting rules with certain depreciation schedules, and I'm not worried about the demand of chips. I'm not worried about people not needing NVIDIA chips, especially as Rubin comes out. We saw the huge increase in Blackwell over Hopper. We're going to see a gigantic increase in Rubin over Blackwell. And we're just getting started with AI. So I'm truly not worried about that. Now, the big thing with the TPUs, which Amazon and Alphabet are both building their own, and Amazon has an entire data center of just their TPUs for Anthropic. I believe the numbers were 500,000 right now, and it's going to get to 1 million, I think sometime 2026. Now, a lot of that is for cloud workloads also, not necessarily inference and training. So if they did not need NVIDIA chips, they wouldn't be buying NVIDIA chips anymore. The fact is that all of these orders are locked in. NVIDIA is given a soft forecast for next year of what they're expecting. And it doesn't seem like anybody is slowing down. So I am, at least for the next year, I am not worried. I did 2 really long posts on X about why the bears are wrong about AI. And unlike the dot-com bubble, this isn't being fueled by venture debt. I mean, really think about this for a sec. People are actually trying to compare what is going on in AI to the dot-com bubble, and I think that they're crazy to do so. This is not a situation where you have a brand new thing called the internet and companies getting built and going public putting .com in their name or .com in their masthead, letterhead, whatever you want to call it, and building a story around what they're going to be able to sell advertising revenue for based on eyeballs and web traffic. Think about how much capital was burned. It's not the same thing. You had these companies that were unprofitable pre-revenue getting huge valuations because venture capital raised huge amounts of funds and they had to deploy capital. This is not that. You're talking about the largest companies in the market driving this. The largest companies in the market doing more than 100 billion each in cash from operations. The largest companies in the market generating huge amounts of profitability and scaling their cloud infrastructure and their AI infrastructure. Two completely different things. And just because an energy company like Oklo, that was a pre-revenue company, went to heights that seemed unrealistic and then got chopped by more than 50% has nothing to do with Microsoft. So right now, still bullish Nvidia, still bullish AI. I want to stress that we have never seen an era since I have been alive where technology stayed stagnant. Technology always advances, and there's an argument to be made that it advances quicker as technological capabilities expand. And if we look at what's going on right now versus what was going on 10 years ago, we are in such a different era. I mean, 10 years ago, SaaS and cloud computing was barely a thing. Think about how much we have advanced on technology. So I think you got to take everything with that the bears say seriously, but actually tear apart their thesis and look through it. And if you do, I think you're going to agree more with me than with their arguments. Because with their arguments, I can't find something that's plausible. So that's where I am on that. I think there's a lot of interesting plays out there. And right now, I'm a shareholder of Nvidia. I have no interest in exiting the position. So that's just where I am on that. Thank you so much for the super chat user JCA69420. I did say I was interested in Iran potentially. My thoughts on them is when I now look at the forward multiples based on how much they have come in, it's really the three of them. CoreWeave, Iran, and Nebius. And I think CoreWeave is the one I'm leaning more toward at the moment. But the three of them have interesting numbers. And when I see that this is not slowing down and neoclouds are not going away, I think the valuations from a forward basis are starting to look more interesting. And CoreWeave is supposed to be profitable in 2027. And I'll show you why I'm liking CoreWeave. We'll use that as an example. I'm going to do it real time for everyone. Oh, I can't even remember the ticker. It makes me think about CrowdStrike. So here's CoreWeave. It got up to 187 to 71. It's fallen by more than 50%. Okay, so it's come back in. Now, when I look at the financials, first I look at the balance sheet, and I see that they have 1.94 billion. Call it 2 billion cash on hand in short-term investments. They have minimal long-term investments, 112 million, and they have 10 billion in long-term debt. So now I go to their income statement and I look at, okay, what is their interest expenses? 990 billion this year. So now I break that down to quarterly. Interest expenses are going up. They haven't really ballooned quarter over quarter, but you're at 310. So going forward, if that was to theoretically stay the same, which it's not, but just for simple math, you'd be at 1.2 billion, 1.24 billion in interest expenses for the next year. So that would bring you into Q4 2026. And they have 1.94 billion in cash on hand. So they're fine from an interest expense landscape of funding it with the cash on the balance sheet. Now, interest expenses are just one of their expenses. Right now, their operating income is profitable. And they have some income tax expenses they're able to deduct on a net income basis. On a trailing 12, they have lost 766 million. So let's say next year they lose $1 billion. Now, that's a hypothetical. I have no idea what they're going to lose. Let's say they lose 1.2 billion. They're still going to have 700 million on the balance sheet, and that's if they don't issue shares to raise capital. Now, I'm expecting them to tap the debt markets more, but when I look at this, it's not the worst set of financials I've ever seen. Now, look, they're spending aggressively on Capex, but they're starting to monetize it. Now, when I look at their earnings, they're expected to be profitable in 2 years from now. So in 2 years from now, they're expected to do 32.18 billion. Give me one sec, everyone. Chris Patel is calling. Let's see if he wants to come on. Hey, I'm live. Do you want to come on?
Sure.
All right, I'll send you. I don't want to get in trouble here. I don't want to get in trouble here. All right, later. Well, I guess I'm not going to get in trouble. Mr. Patel will be joining us. So let me throw the StreamYard link out to him. Bear with me, everyone. You're going to get a twofer. Let's see. Chris Patel in the chat. Boom. All right. So I'm going to finish this up because I have no idea why he called me, but we will ask him live why he was calling me. And we will talk about whatever he wants to talk about. But be that as it may, when I look at their financials and I look at where they're supposed to be, according to 16 analysts who follow this company way closer than I do, it gets interesting. So, yes, I am considering investments in NeoClouds. CoreWeave is where I'm leaning toward. Het, thank you so much for the $4.99 super chat. Really appreciate it. Appreciate everybody's support. You guys are the best. I really appreciate everything. I love streaming with everybody, answering questions. So really, look who's here. I called Matt. No. Don't do that, Matt. I have the phone records to prove that you and I were on the phone. You're getting on a plane. What time is it? It's 4:49. This guy's at an airport breaking my chops. All right. He's at an airport. I offered for him to come on. I was not able, when I called him, to do something right away. And I asked him what time he had until. We just couldn't make it work. Matt was asked. Matt is always asked to come on. So, I need to figure something out to stream more with Matt. I really like streaming with Matt. But, he's a busy guy. He's getting on a plane. He's do some adult things. So, he's in the Uber. Matt, would you like a link? I will send you a link right now. Put it in the chat if you want a link. Oh, Matty money. Matt. Well, I'm trying to figure out why Chris was calling me. Maybe it was about Meta because I sent him a message about Meta. Could be about debt. I don't know. We're going to find out. I'm actually pretty interested in what he was thinking. So believe it or not, I was actually going to wrap like very soon. So I guess we're not wrapping anymore. And I guess to kill time until Chris comes in, I'll let everybody know what I'm looking at. So there's a few things I'm looking at. I really like QXO here. Oh, by the way, I will be live tonight at 9:30 with two legends in the TCG market and alternative asset market. So Alex Nostalgianomics, who runs a huge rip and ship business, and then Brian Pokiani is going to come on, and he runs a huge Pokemon selling business. He's one of the original people that was selling Japanese, and fascinating guy. So it's going to be awesome. So tonight at 9:30. But what I'm looking at right now as far as stocks is my themes for 2026 are the big get bigger. Okay. I think the big six. So the MAG, I'm going to start calling them the spectacular six. I like the way that sounds because Tesla's not part of it. So my spectacular six are Alphabet, Amazon, Meta, Microsoft, Nvidia, Apple. I think they just get bigger. I think the spectacular six just get bigger. I think that you can't compete with these companies. And I like them. Now, the four horsemen are the hyperscalers. So the four horsemen are Microsoft, Amazon, Alphabet, Meta. Now, I'm planning on building out a position in Microsoft. I really like Microsoft. I should have bought them earlier, and I think getting them around 474 was a good price. If they fall, I'll keep buying, and if they rebound, I'll keep buying. I think Microsoft's one of the most important companies. Then Alphabet's run a lot, so I'm not too keen on buying here, even though I think it's a good valuation. I was pounding the table much earlier in the year. I like Amazon a lot, everyone. Look, my thesis on Amazon has not changed. It's actually pretty simple. If they are going to hit $1 trillion in revenue in 2029, like expected, if they can get to a 20% operating margin, that would be $200 billion in operating income. That's very exciting to me because that's way more than anybody is doing right now. And Amazon is what is Amazon's market cap right now? $2.4 trillion. So, I mean, if they can pull that off, I mean, I could see them being a $5 to $7 trillion company. And we'll see. I mean, I think it's one of the more interesting plays right now. So those are mine for right now. And Meta at this valuation makes no sense, but I have a full position, so I'm not adding. But I do plan on adding to Amazon and Microsoft. Like those are the two I'm very interested in right now from the spectacular six. And then I like the adjacent plays. I like Energy Transfer so much right now. I mean, ET, I'm going to show some receipts on ET, okay? Has not had a great year. It's down 13% this year. The yield is just over 8%. But you look at where ET was 5 years ago, it's up 157%. I mean, this is a company that was trading at $6 during 2020 when the country basically shut down. And I think we have a very big need for energy. And Energy Transfer has over 120,000 miles of pipe. You can't replicate their infrastructure. They're very big in exporting. Great company. And a lot of people can say it's easy to talk about ET, where it is today, right? Okay, cool. I'm talking about ET for a long time. Like, think about this. When the world was shutting down, May 28th, 2020, Energy Transfer is yielding 14%, and I was bullish. Think about that. May 2020, the height of the pandemic, August 2020, I mean, December 2020, 2021. I mean, I've been bullish for a very long time on Energy Transfer. And I have studied this company a lot. I feel really good about them. But I feel good about them for different reasons. Do I think Energy Transfer is going to 30? No, I don't. But I do believe Energy Transfer is going to see increased utilization rates on the volume going through its system. I think they'll continue increasing the distribution. And I think that they will appreciate a little bit in value. My fair value, I believe the last time I did the numbers was like $19.70 or something like that. So, look, I'm not expecting Energy Transfer to double here. I do think they're going to be in the $20 to $25 range in the next year or two. And I will just freaking continue compounding the distribution and plowing that cash right back into the investment. So I'm really excited about them, especially in a world where you're seeing data centers continue to increase. Thank you for the super chat. I actually have no idea what that company is. Let me see. Maybe if I type it in, it'll jog my memory. The fastest AI infrastructure? The hell is this? Blazing AI inference powered by the world's fastest processor. I'm actually not familiar with them. It sounds somewhat familiar, but I can't think about it. I can't recall it. So I don't know. I'm sorry. I'll put it on my list of things to do due diligence on. Okay. I'm with you guys. I do need to stop sleeping on TeraWolf. I know that a lot of people like it. I will do a little bit more research into it. Man, Sunday coffee just hits differently. There's something about sitting down. So I had a cup earlier on the couch and I was just relaxing. Normally, I get a venti from Starbucks and I drive to the office and then I'm finishing it while I work. And I don't get to freaking enjoy my coffee. This is really nice enjoying coffee. I just got to say, it's really nice. Steve needs to stop sleeping so he's live 24/7. Thanks, Matt. Thanks, Matt. Yeah, you know. Oh, all right, everyone. Is his so he came on and backstage and he left. I guarantee you because he screwed up the mic because he knew I was going to say, let's make a bet. Is his mic going to work or not? So now when he comes back, I'm going to guarantee you his mic's going to work. And that's why he popped in, popped out. And it looks like he's freaking laughing also. So I'm going to say that's why he exited and came back in. It doesn't work. It did not work. It still doesn't work. I need to get a prediction market on if Chris's mic is going to freaking work. I can't believe this. I apologize, Chris. I'm making you laugh, but
there we go. Okay, two things. You have to stop sending me the link on X, man. I have like so many different authentications, like dual factor authentication that I have to go through to get onto my X that that's what delays me every time. And then
all right. So where do you want your email?
No, WhatsApp. Just send it on WhatsApp.
I don't have WhatsApp on my computer.
Just download it. It takes 2 seconds. That's one of the beauty. You know what? Today is a great day to talk about WhatsApp because I think the deep dive that I wanted to do, one of those hidden assets that Meta has.
Well, hold on. Are we doing Meta tomorrow night? I sent you a message. Are we doing Meta tomorrow?
We can if you want. But today, I think we could just talk about that very briefly.
Okay.
one of the things that people don't necessarily know about Meta is that one, they own WhatsApp. Everyone knows that. But WhatsApp is actually one of the most popular and used applications in countries like Brazil and India. And if you know like how knowledge graphs work with users, dude, it's big. Now, one of the reasons why I really like WhatsApp is that I have an iPad, I have a phone, I have my desktop PC, right? I have multiple devices and they all have WhatsApp on there and I'm linked to it. The best thing is I don't have to worry like, oh, did iMessage send things to my desktop? Like if you texted me the link on my phone, right? I I can't use that on my desktop because it's a Windows-based desktop. I can click on it from my laptop, but I use my Windows here. So same thing with other people. Like, so there are so many people that are on different devices, but WhatsApp unifies everything. And I'm telling you, it's outside of the US. I know a lot of people like, oh, monetization of WhatsApp. Like, how do you monetize that? It is huge. Just look it up, dude. Look it up. You'll see what I mean.
I'm actually setting it up right now for you on my computer.
Yeah, WhatsApp isn't used in the US versus outside. So WhatsApp is actually used like a good amount in the US, but it's just not as popular as in India. Like I'm in like multiple like group chats with people from India and other places. Bro, let me tell you, they're on that thing all day long. All day long. You know. So, and the thing is, the amount of monetization they get from it, it's pretty insane. Instagram has been getting better and better in terms of competing with TikTok. And so the amount of user attention has been growing on Instagram a lot. So, you know, there's, like I said, there's so many verticals that Meta has for the next like 5 years of growth. And a lot of their AI targeting with ads is just growing every day. So, you know, everyone uses WhatsApp in the UK. It's like a standard. Absolutely. The US existing infrastructure is the reason WhatsApp is more popular abroad. Yeah. I see all Spanish and Hispanic people use WhatsApp. WhatsApp is also popular in South America. Even uncles have these groups on WhatsApp. Yeah. So I'm telling you guys, WhatsApp is the super app around the world. And the thing is, sometimes our own bias, because we all, like in the US, we all have iPhones. So we think iMessage is like the standard, right? But around the world, WhatsApp is actually the standard that's out there for people communicating between groups. And then also the way that it's really like synced up to your Instagram account. So if you're having a conversation, like I have a group chat with me and my cousins where we send each other memes and shit. Dude, 2 seconds, Instagram linked, boom, sends it over. And it's awesome, you know? So WhatsApp is popular in Belgium. WhatsApp is the standard here in Italy. Both private and businesses use it. Every job I had was added in a WhatsApp group. Absolutely. You know, most use WhatsApp because it's untraceable. Yeah, it's fully encrypted as well. WeChat is more popular in Asia. I think in China, WeChat is super popular. But
all right, WhatsApp is now on my computer, so I no longer have an excuse.
Yeah. Dude, and trust me, your life will be so much easier and simpler because you have an iPad. Do you have a WhatsApp on your iPad?
No.
Tell you, put it on there. I don't know.
I will put it on my iPad.
Yeah, I'm telling you, it's device agnostic, which is awesome. Like it's on all the applications. So anytime you and even me, like there are times where I need my wife to send me something, right? And I need to access it on my computer. So she'll just go to like her WhatsApp and she'll send, like, let's say I want some pictures from her phone, right? Like she took some pictures. I want it and I want to like save it to my Google Drive or whatever. She can email it to me, or in 2 seconds, she can just go to WhatsApp, whichever pictures, send, and it literally appears on my computer for me. You know, you'll see the use case once you actually have it on your desktop, and then you have it on your phone and you have it on your iPad. You'll see like you can go in between the conversation, and it's awesome.
Well, I will start sending you the links via WhatsApp. So,
yeah,
what did you want to discuss? You obviously called me for a reason. What's on your mind?
Well, I was gonna talk to you about like what are the opportunities in Meta, but you were already live, so I said, all right, fuck it, I'll join. You know.
Yeah, I mean, we can do Meta right now if you want, and pick something else for tomorrow.
Yeah.
It's up to you. Or you can
Yeah.
do just a idea generating now and go through the numbers tomorrow. Why don't we do that? Look, my case for Meta has been the same for 4 years, 5 years now. It's
Mhm.
expanded a little, but Zuck used to say in 2022 on the conference calls, at some point, our usage will stop growing and it'll
Mhm.
plateau and eventually it'll start decreasing.
Mhm.
That day has not come yet. They're still
Yeah.
growing DAUs quarter over quarter, year over year.
Mhm.
So, as Chris alluded to, WhatsApp, and it's not just applicable to WhatsApp, you have Instagram and Facebook being utilized tremendously. So you have more than a third of the global population on their platforms. I don't
Yeah.
know another company that has more than a third of the global population using it. Now, when I think about how they've monetized Instagram and Facebook, I think there's a whole nother layer for monetizing WhatsApp. And that's always
Yeah.
been something that could be another vertical for them. I
Yeah.
do think that they are going to harvest the power of AI. And I think your idea about data centers is interesting. I do
Mhm.
think they're going to be able to charge an upcharge fee for advertising and building reels and other things with AI. And I do think that Meta has the ability to control the wearable market
Yeah.
because I, for one, want sunglasses or a pair of glasses, whatever it is, that's form factor, just like this, where I
Mhm.
can transcend a screen and have everything in front of me and have an open field of what I use. So
Right.
I think there's a lot of things that makes Meta interesting. And when I run the numbers, it's very easy to get behind.
Yeah, I mean, the company is a free cash flow machine, you know? And
Yeah.
even the spending that they're doing on AI right now, they're seeing the value. Otherwise, they wouldn't spend the money, you know? And if you really look at the development around all the stuff that they have, they're eventually going to end up, and that's the thing with Zuck. Zuck's smart enough to figure out how to basically monetize any excess compute if they really do overbuild, right? I mean, it's the same thing with Google. It's the same thing with Microsoft. It's the same thing with all of these guys. You know, this is one of those things that's going to drive user. It's going to drive revenue for the next 20 years. Like right now, if you look at the projections on AWS, GCP, Microsoft, they're they're pretty they're pretty even in terms of like market share. Where one like right now, GCP is growing their market share. Amazon, AWS is losing market share, but not by a lot. And Microsoft is also like kind of gaining a little bit of market share. But the thing is, the total pie is growing at about 15 to 20% per year. So, you know, if you look at Google, Google's growing at 20, 30%, but that's because they're taking a little bit of market share, right? Amazon is just retaining its market share, but the overall pie just keeps getting bigger, bigger, and bigger. And also, you know, the way that scaling works is that the more you build out, the cheaper you do it the next time, and the next time after that it's cheaper. Then you have your entire ecosystem ready to go, and it's a great it's a great business to be in. That's very durable. It's very hard for people to compete against it. Um, so yeah, I mean, in terms of like the Mag 7 right now, I can't believe Meta is only what's the market cap on Meta? Like 1.5 billion?
1.34 or something like that.
Yeah, 1.3 billion on
Crazy.
Meta's market cap. When you look at their operating income, how crazy high it is, and then what their revenue growth potential is. So, you know, you don't get a lot of discounts on Meta. So when you get those discounts on Meta, you buy and you just chill, you know.
And I do want to add from their deck. So this is their Q3 deck. A lot of
Yeah.
people talk shit about Zuck and Meta because of his losses on Reality Labs. As somebody who's owned Meta I'm a day one Meta guy. Day two, is like when it IPO'd, it pumped to 30 and then fell. I got my first tranche of shares in 19. So I'm like a day one Meta guy. Still have them. Now, Zuck is losing more than 4 billion a quarter from Reality Labs. But his family of apps operating income is almost 25 billion. So their total income from operations on a quarterly basis is now exceeding 20 billion. So while a lot of people are using that as a bear case, how about this? What if he's right? And hasn't he earned the right to try to build that out? I think he has, considering he's funding it from profitability. And I'm not going to go against Zuck. The guy has built one of the greatest companies ever. He knows well more than me and well more than everybody else about his business. So I say he's earned the right to freaking try this. So that's where I am on Reality Labs.
Well,
Not to mention, 40% operating margin is nothing to sneeze at.
You have to, like, if you're at that level, you have to keep trying to do new things, right? Amazon, do you know how much money they spend on random bullshit that never goes anywhere? But that's the thing. If you don't try, then what are you going to end up with? You're going to end up like Apple, very little revenue growth, and you're going to try to sell people overpriced socks to store their phones. You know? I mean, Apple's a great company. Don't get me wrong. It's just Apple has lost its way because they're playing it really safe, which is fine. If there's some investors that want to have that safe compounder, that is what Apple will get you. But in terms of like total upward growth, it's hard, man.
Where or who should take over Apple?
What do you mean, like CEO wise?
Yeah.
I don't know if anyone can take over Apple and get it to do what it's done.
Like, who should be Tim Cook's successor?
It's hard, man. These leadership transitions, by the way, that could actually be a short case for Apple. If Tim Cook leaves and the next guy that comes along does not have the same kind of like credibility, the market may re-rate Apple much lower because they're like, oh, you know what? This guy's not as good as a steward of capital as Tim Cook was. You know, the secret behind Tim Cook has been that this guy is an operations guy. He's the reason why Apple is one of the most profitable companies today. It's not that Steve Jobs wasn't good. Steve Jobs was like this visionary guy with great ideas that put pen to paper and, you know, like he literally made dreams come true. But it was Tim Cook who figured out all the supply chains, got everything, got the app ecosystem together. And so, you know, a lot of what we're seeing today, even though Steve Jobs gets a lot of the credit for it, you have to remember there's like a number two that brings in a lot of the credibility and the operations that make things work. Like one of the reasons why Andy Jassy is the CEO of Amazon is because Andy Jassy built AWS, and AWS has been the profit driver behind Amazon for the longest time. So Amazon has not made any money as much as well, not as much. They haven't made as much money on their e-commerce business as they have on their AWS business. Now, under Jassy, some of the things have changed with AWS, where you've got advertising revenue coming in, you've got Prime memberships coming in, you've got all this high margin businesses, all these side businesses that are adding to Amazon's profitability. You know, and Andy Jassy is a really good CEO. He knows what he's doing. So I don't know enough about the leadership over at Apple to make a judgment call on who the next person should be.
Neither do I. I have no idea. I don't.
You know, it was the same thing. A lot of people will give Sundar shit right now, but you know, like Eric Schmidt told Sundar was like, look, we need to do a browser. If we do browser, we'll be capturing market share. That will be our gateway into maintaining our search monopoly. Eric Schmidt said, absolutely not. Sundar Pichai had to go behind Eric Schmidt's back and actually do everything, had Chrome together, and Chrome is now the most popular browser on the planet. Can you believe that shit? So Sundar is not the guy that's just going to sit there and take it, but that's what you need sometimes. You need to have the guys that are going to break a few eggs, man. You know?
Everybody was down on Alphabet except you, me, and a couple other people. Look how that story
Dude,
turned out.
It was hard. It was hard. Everyone was saying search is going to get disrupted. Google doesn't have any avenues of monetization. I was just like, first of all, search may eventually die a death, like a slow death, but it's not going to die it right away. And there are so many things that people use outside of the search ecosystem for Google that they can replace that missing search revenue very easily over the next 10 to 15 years. You've got Waymo, you've got what is that thing called, GCP, you've got Google Workspaces, all of those things. Those are high margin business. You've got YouTube, you've got Google Ad Spaces. I mean, I don't think the search could, yeah, and search could evolve. So Google's here to stay, and they're not willing to just be like, oh yeah, we're getting disrupted, no big deal, you know.
Yeah, I gotta find my notes, but when you think about the amount that AI overviews and Gemini is being used, it's not getting cannibalized. And look, the numbers on search, they just continue to expand. So we'll see. I still like Alphabet. I just don't think it's the deal that it once was.
Yeah. And the thing is, yeah, I agree with that. So some people have been reaching out to me on Patreon and saying, we have spreads that go into like 275s. Should I close my short leg and open a long leg further out into, like, let's say 500 something? And I'm like, don't do that. First of all, there could be a pullback. You know, you never know. Like, you've already got the win. Don't risk it. And right now, if you look at on an EV to EBITDA multiple, I'm not saying Google is cheap, but it's not expensive. It's like fair value. And so the way that you make money in this market, you find things that are undervalued. Like right now, I think it's very easy to see how undervalued Meta is. Can you show everyone the numbers for Meta just one more time? Because from yesterday, so people understand.
The numbers that you made fun of?
Huh? The
numbers you made fun of?
I didn't make fun of your numbers. I said you're trusting the analysts too much. That's what I said. Because I'm like, the analysts don't necessarily, you know.
Yeah, I agree with you that they normally get it wrong. Absolutely. And I do like the number that you came up with much better than their numbers, by the way.
Yeah, because it agrees with your thesis.
Yeah, I'm gonna show the numbers and I'm gonna show the operating margins. I think the margins are really important too.
Yeah.
And look, Chris and I both think that the EPS is going to be higher for Meta going forward, but they're trading based on the analyst estimates, more than 30 analysts at 17.68 times 2027 earnings with 28% EPS growth over the next 2 years. They're trading at a lower multiple than Coca-Cola. I mean, that's just not normal. Sorry.
Yeah. You don't get a lot of opportunities in the market to pick up compounders like Meta at these prices. And like I said, the only reason why they're getting hit like this is because of one-time tax charges, which are going to be value accretive going forward. You know, the company, thank God, got de-risked a little bit. I'll take it. Okay, I'll take it.
Yeah, and I also think Microsoft and Amazon are very interesting here too. I mean, when's the last time you were able to buy Microsoft at 21 times forward?
That's rare.
Very rare. And Microsoft's got close to 40% EPS growth.
Yeah.
And that's why I just became a shareholder in Microsoft. Now, from a margin aspect, Meta is super interesting, and we'll go them against Broadcom because they're basically similar.
Yeah.
Let me zoom out one. All right, there we go. All right. I guess I got to zoom in one. All right. So Meta's a 1.49 trillion market cap. I guess they rebounded a little bit. Broadcom is 1.6 trillion. Now, let me move Nvidia out and let's do something here. So Meta's market cap, Broadcom's market cap is 100 billion more, but Meta's doing 129 billion more in revenue. Yeah. They're doing 65 billion more in EBITDA, 57 billion more operating income,
And they're not a cyclical business.
And they're not a cyclical business. And look at the margins. I mean, on a net income margin, they're basically the same thing. So
I think the more important thing is that they're not cyclical, man. Like
Yeah.
people that are investing in semiconductors right now, all the AMD bulls, all the Nvidia bulls. Let me tell you something. You are still invested. I don't care what anyone says. It's a cyclical business. There are times where semiconductors are the hottest thing on the planet, and then all of a sudden they're not. Look at what happened to Intel. Okay. Intel was one of the largest value traps that you could have gone into. Why? Because they got comfortable. They had the majority of the CPU market. AMD comes in, you know, wrecks them with their Ryzen CPUs, and then they never really get too many GPUs. And Jensen is smart enough to get around it, but at the end of the day, I think that there's going to be a point where Nvidia's growth is going to slow down, not because the demand for the GPUs is going to go down, but because the sheer electrical grid capacity is going to be so strained, and it's going to be a political problem. Because right now, I was actually talking to someone who, I was at lunch, and they're like, I'm from Texas, and my electricity prices since I bought my home in pre-COVID, 3x what they used to pay. 3x. You want a topic that makes you lose your election? It's electricity bills being 3 to 4 times what you paid for them. Literally, like less than 5 years ago.
We need to invest in energy infrastructure, and that is one area that's being overlooked. And it's not just pipeline companies; the utility companies are being overlooked. I mean, NextEra Energy, Southern Company, and Dominion. I think all three are really interesting here because I'm not seeing anything disrupting them. And NextEra is huge in renewables as well as natural gas, and and I said this earlier in the show, there's a lot of adjacent plays to the build out. And I do think there's going to be some big opportunities there.
I agree.
Yeah, it's definitely a problem. It's a big political problem. We need more energy because these data centers are contracting so much. It is increasing the price per kilowatt hour, and they're not going to have a choice but to go nuclear and increase natural gas fired power plants.
Dude, for God's sakes, they're restarting old nuclear plants.
Right.
That's where we are in this.
That's where we are in this. Whatever it is. Yeah, the restarting.
3 Mile Island. 3 Mile Island. You know?
And you know what my gripe was? Hold on, let me get your opinion on this. I got a big gripe with Oklo and SMR catching a bid yet. And I know some people are going to say, well, Steve, they're SMRs, they're not freaking these huge facilities, but freaking Southern Company through Southern Nuclear does 27%, I believe, of Georgia's power. Like,
yeah, because we have Vogtle, the Vogtle nuclear plants here. But the problem is this thing was so over budget, Steve.
No,
I mean, this is your
my thing with that was, and this is what Chris is talking about, plant Vogtle. But my thing is, Southern Company has the expertise that if nuclear is to expand, you have to think that they're going to be a player in it. So the fact that they weren't catching some type of bid while those other ones were that don't generate revenue, freaking made no sense to me.
I don't know, brother. I definitely think that electricity usage is gonna keep rocketing higher, along with data centers. You know, I don't think that that's slowing down anytime soon.
No, it's not.
The question here is, where do we put all these plants that we need, and what's the electrical generation capacity? I mean, it's not just, oh yeah, let's build 5 power plants. You have to build a power plant. You have to, like, all of these things are usually steam turbines. So even if you do like a coal and a thermal plant, you still need gas turbines. If you do natural gas, you need gas turbines. All of those come from GE Vernova. Put up the stock price of GE Vernova. Look at what happened to that.
What's the ticker?
GEV. Look at that beast. Ever since they split from GE, look at that power business.
131 to 555 in less than 2 years.
Yeah.
Yeah.
Hitachi makes turbines too. Yeah.
There's an article that I wrote, and there's an image of, oh, I found it. All right. So this is an image of where all the capacity for data centers is right now. So here's my theory. I don't think you can put more data centers in the DC area.
No,
I really don't.
Much in Virginia already. Yeah.
I mean, it's just it's crazy how much there is. And I know that the reason why there's so much there is because Pentagon, DOD, freaking latency. I get it.
Also population.
Seeing,
population. Don't forget about that.
Yeah, but I think you're going to start seeing middle America become where, like, why would there's nothing there? Why wouldn't you just freaking build out there?
Like Minnesota and like the Midwest?
Yeah, why not? Cheap, think about it, cheap land.
Okay.
And up here, cold, so it helps with heating. You have a ton of land that you can do solar on if you want to, in addition to building out electrical supply.
Yeah, so, tornadoes.
Well, yeah, no, that's a legit reason. But I just think it's going to be so much cheaper to build out there. I wouldn't be surprised if we see more building out there. How much more can you expand in Texas and DC?
If I was the one planning where to put these things, I would put it in West Virginia.
Yeah.
West Virginia, they've got the coal belt there, but they also have a lot of natural gas around there. So the nat gas plants, you can build a plant right there. You can have the you can do the electrification work right there. The area is cheap and needs the jobs. West Virginia is a place where, around the Appalachian Mountains and stuff, it's really, really underdeveloped. And I think the federal government would actually like to invest a lot more money there. So I'd say.
And this is what Chris is talking about. So you have the Marcellus Shale Field, which is huge right there.
Yeah. Please, God, no, don't come to West Virginia. Why not? Yeah. I'll be scared if California started building a nuclear plant.
That's not happening.
Yeah. Virginia has gas in the ground, and you can have your own gas well if it's under your property. Yeah. No, like I said, for me, West Virginia is a great place to look. I mean, the area could use some revitalization too. Like more money getting pumped into West Virginia would be good. Country road, take me home, West Virginia.
Yeah. There is a lot of opportunity, and I'm starting to wonder what's Oxy's play with getting rid of that segment. I think they're setting themselves up for an acquisition.
Which segment are they getting rid of?
Aren't they getting rid of the Matt would know it, it's escaping me. Hold on. Oxy. They're divesting something.
I heard Detroit might make a comeback one day. Detroit's getting nicer, some parts of it, West Virginia doesn't have the youth. Yeah, sometimes you also need people.
So between April and July, they completed multiple transactions, divesting non-core and select non-operated Permian Basin upstream assets. And in July, they entered into an agreement with Enterprise Products to sell an entity that owns certain gas gathering assets in Midlands. And the transactions bring the total divestitures since December 2023 to $4 billion. There was something big that they were spinning out. I just can't remember what it was.
Yeah, I'm not sure what it is, so I can't say for sure.
But
The
yeah,
problem is
Oxy
oil prices are so low right now.
They
You know,
are.
like the break evens are I'm not sure how much of the Permian is at break even right now. So
If Chevron falls a little bit further,
Mhm.
I'm going to buy them again. I used to own them. I got out of them a while ago. The only super majors I'm in are Exxon and BP. But
Okay.
I like Mike Wirth. I think Mike Wirth is freaking great. The acquisition of Hess, I think, is being overlooked by a lot of people. I think their free cash flow is going to explode. And they're in one of the best positioned companies for a low price per barrel market with oil. And I think if you get oil retracing more, you could see Chevron pick up a couple of stragglers like Devon, like a Diamondback or somebody, and really position themselves looking 3 or 4 years out. So I think stuff like that's interesting.
Someone said most Permian is still profitable at 50. Yeah, but it's probably really razor thin margins, man. Like, yeah, it's probably like really razor thin. I know 50 to like 55 is probably right there. No, I did not just rip one. I just plugged in my iPad. Yeah. All right. I mean, there's not a lot of things that I've researched other than Meta tonight.
Well, we'll do
yeah.
Meta tomorrow. We'll do like a full Meta for tomorrow night at 8.
I could do one for the cruise lines for Norwegian if you want, but that's again another like deep dive into accounting that people don't necessarily know. It's so dumb. Like the way that sometimes the accounting is, it ends up causing unnecessary panic. And the thing is, like, once you look through it, it's like, what? How does this even make sense? You know, like I'll just do a brief thing with you guys and just show you. So
while you're getting that up,
yeah.
Chevron operating break even is around $30 per barrel. Now, in order to cover the cost of Capex plus the dividend through 2030, they needed to be at 50 or above, according to ChatGPT.
Okay. Let me see.
You guys love this freaking company.
It's so easy, dude. I love
I gotta start using it and learn how to use it.
Use my coupon code, please. I'll go put my coupon code in here.
I will use your coupon code if I do it.
Because I need them to, you know, it's funny. They gave Tanner free monthly membership. I don't have free. I still pay every month.
Do you?
So I gotta reach out. Yeah, because I'm not as big of a creator as Tanner is. I don't even know if I'm a creator, technically speaking. But let's see. Okay, so you see this right here, Norwegian Cruise Lines. Everyone is looking at this, and they're looking at where is this interest expense? So when people look at this and they're like, wow, look at the quarterly, the annual interest expense, it's getting worse, right? So if we look at the interest expense and then we look at diluted EPS, because EPS is what matters, and we'll look at top line revenue. And let's do revenue. Okay, so top line revenue. So let me just do top line revenue separately. No, that didn't actually work out as. Let's do the debt separately. Okay, whatever. You know what? Just for illustration purposes. So if you look at the debt for Norwegian Cruise Lines, they were doing about $770 million in debt per year, right? So they were adding new ships, but they were also growing their EBITDA at the same exact time. So you can see up until March, everything was good, right? And your EPS was actually, one second, diluted EPS. Diluted EPS. Okay, there we go. Diluted EPS was growing, and it got to about $1.9 per share. Ever since then, their diluted EPS has been going on the downward move, right? And because it's been going on the downward move, the company's been re-rated lower. So if you look at the stock price, and let me put this separately. There's a stock price. I need this actually. I need. Okay, there we go. So you can see here, because of that, the stock price has gone from a high of 28 down to 15 during Liberation Day, and then it went higher to 25 in September. Ever since then, it's kind of come down, and then now it's hanging around $18, $19. Insiders, by the way, have been buying at 18. Now, one of the reasons why is because if you look at the diluted earnings per share, it went from 1.9 to 1.4, right? So it's like, wow, their earnings are declining because look at their interest charges. Their interest charges are going higher and higher, right? The part that everyone seems to miss about this increase in interest, it's why. Why did their interest jump all of a sudden? Well, one of the things that they did actually, it's in their slides. 1 second, investor relations, and right here. They did a transaction whereby they were able to reduce down the amount of dilution in the future by basically redoing the debt. And let me see if I can find that for you guys. Is it here? Okay. All right, right here. So you see this right here, net income, right? 419 million. Last year, their net income in the same 3 months was 474 million. So everyone looks at this and be like, wow, their earnings went down. I don't want to be in this. Their earnings are declining. But look at this giant $154 million extinguishment of debt and modifications charge that they took. Okay. What this essentially, they essentially did was they had a bunch of convertible shares that they were able to take and actually put them into the future, right? And save on dilution in the future by changing up those exchangeable notes. And because of that transaction, they had to, on paper, cash wasn't impacted. On paper, they had to basically take the charge. So on paper, they're down 150 million on paper. Now, if you see right here, where is it? Number 3, losses on extinguishment of debt and modification of debt are included in interest expense. So even though this looked like an interest expense, if you look at the diluted share count, right? The diluted share count actually went down. So last year, the diluted share count was 514 million. Now the diluted share count is 495 million. So this is the part that people like will look at the adjusted and they'll be like, oh, wait a second, this doesn't make sense. So if you look at the diluted earnings per share last month, when this came out, it was 86 cents. But if you adjust it for that one-time, not even expense, but one-time change in extinguishment, they actually earned $1.20. The market sold these guys off, like literally sold off. I think it was down like 13-14% in the day. It was so dumb. So I was like, yo, I'll buy the dip. If insiders are buying the dip, I'll buy the dip, you know. And so next year, their earnings are projected to be close to like $2.50. And for a business like this that's reducing down their debt, easily this thing gets to a certain price that that I think is good. But this is what I mean by sometimes when it comes to like analysts, they sometimes look a little bit too raw in their earnings, and I think a lot of the trading that's happening right now is being done by algos who are basically like looking at things and trying to buy and sell, and they don't necessarily do the accounting logic that me and you are doing right now. Like, look at the whole thing with Meta. Meta took that charge because of one beautiful, the one big beautiful bill thing. But then if you look at the earnings growth that they're going to have going forward, it's actually going to be value accretive to shareholders. So, yeah, good times, good times.
Yeah, I agree with a lot of that. I mean, we looked at Fiserv; it's pretty interesting. And Krishna, I did see your super chat. I have to do more work on Oscar. I just don't know enough about what's going on with all the stuff going on in healthcare to see how it's going to impact them. But the numbers last time I looked at them were interesting, but it's hard for me to handicap it going forward. I mean,
there's a lot of uncertainty with Oscar because Oscar is primarily in the ACA markets. So right now there was open enrollment, and during open enrollment, these guys had to raise their premium significantly. So it's really hard to determine what the medical loss ratio is going to be next year, because what's going to happen is you're going to have this situation where the way that medical loss ratio ends up working out for people who are in ACA is that there's healthy people and there's sick people, right? The healthy people don't use a lot of medical care. The sick people use a lot of medical care. And if you do everything together, you pool them together, you basically, even out everything, and you're able to build out a margin from that. The challenge is without these subsidies, a lot of people are going into open enrollment and saying, I don't want to get ACA right now. I want to stay out of ACA. Maybe I'll risk it and not have health insurance, especially if you're young, you're 20 years old, you might end up going with a catastrophic plan instead of the ACA. And so Oscar might end up with a lot of sick people on their coverage, and Oscar is going to have to pay out in order to maintain everything next year. So it's very hard to know where Oscar is going to end up, unfortunately. So I think with regards to like UNH, I think it's an easier story because most of their pay is coming from commercial and Medicare. So there's a little bit easier time figuring out what they're going to do versus Oscar. And Oscar is not very, it's still very, very early in Oscar's life cycle to be like, oh yeah, we really want to invest in this, considering that we don't have any idea on when this ACA thing is going to get resolved. You could be like United Healthcare and deny every treatment and make billions. I mean, whatever. That's what you think. Sure. Yeah. Health insurance will become politicized. Government will let it fail. People going into Oscar or UNH, I see why it's a decent play. I mean, I have some thesis that are like super long term. I think the introduction of GLP-1s and the cost reductions on GLP-1s are going to lower rates of obesity and heart issues and all these other comorbidities over the long term. And I think the health insurance business is just going to become more profitable. So. Yeah.
Yeah, I don't have a thesis on Oscar anymore, and I don't want to spend the time to try to understand what's going to happen because it can swing no matter what day it is with what's going to happen. So it's not for me right now.
Yeah, I think some people are bullish on like healthcare, like insurance, primarily because it's non-cyclical. It's always like going to go up and to the right. But what does happen is sometimes margins can get compressed. And if you have margin compression, then you've got to deal with that, and that's what UNH and Elevance and all of these guys are going through. Now, the thing is, to be honest, margins can be improved via premium increases, and they have like different ways that they can monetize their insurance roles. Yeah, it's not a discussion that I think can be done in a very short period of time. There's a lot of things to it. The key is once you're in the first and second quarter, we'll know more about the medical loss ratios going forward. You know, have you looked at HNGE Healthcare? I haven't seen it. I don't know.
I have no idea what that is.
Yeah. GLP-1s will see explosive growth once it gets pill form for the masses. I agree. That should be coming up in the next probably 60 to 90 days. Novo Nordisk has an oral medication that's supposed to be coming out where FDA approval. And they've already, like, they're so confident that they're going to get FDA approval that they've already started manufacturing this thing. And they've been manufacturing at high dose, like not high dose, like high volumes. Eli Lilly is going to do really well. That's why Eli Lilly now is like the number one healthcare stock in the world. They're $1 trillion. How much of your portfolio is in ASTS? Not a lot. ASTS is a moonshot play.
What I haven't even looked at in God knows how long. 51, it's still staying up there.
Yeah.
This thing hit 94 in October. Jesus Christ.
Dude, a lot of these high beta names, they came down. Medicare, Medicaid will cover GLP-1s for weight loss. Some conditions still, yeah. Hence, LLY is at new all-time highs. Yep, absolutely. Yeah, Eli Lilly's definitely going to kill it with Mounjaro, Zepbound. They have their own, what is that thing called? Oral versions coming out as well. But the data that I'm seeing is just telling me that in the future, the amount of money that's going towards obesity care is going to increase significantly, and I think the overall healthcare outcomes are going to improve. But it's not going to be visible like right away. Novo Nordisk is going to benefit too because I think the entire market is growing. Except Novo Nordisk, they have semaglutide, which is Ozempic, which is not technically as effective as Mounjaro or Wegovy, whatever you want to call it. Mounjaro and Wegovy have a dual pathway, whereas Ozempic only has one pathway. So that's why there is a new drug that Novo Nordisk is working on called CagriSema, which is giving similar results to Eli Lilly's Mounjaro, and it's a dual acting drug as well, where one part is semaglutide, another part is cagrilintide, and basically like it impacts a different pathway towards helping people lose weight. So yeah. And then oral is going to be there too. So MASH, lose weight without losing muscle mass. Yeah.
Wasn't that why people were loving Hims? Because they felt that they were going to get into the proprietary drug based on. Isn't that why people loved Hims? Because they were supposed to get into the proprietary drugs based on your genes?
I don't know.
That's something we need to look into. We need to look into freaking genomics. I'm still not convinced that that's not going to be huge in the future.
I'm not convinced on it, dude. Personalized medicine is still like a ways. It's up there. It's up there. Yeah, June is right. All medications have side effects. There's like you're introducing a foreign object into you. You're gonna have side effects. Except some side effects are going to be more mild. Some of them are going to be more. And that's the thing that's why people do clinical trials to figure out like, okay, what kind of end result do people get? You know, Hims has incoming tests from home, which is decent, but I'm more excited about peptides. Yeah, I haven't done enough research, unfortunately. So
dude, I want to go on peptides.
Like which ones?
I don't know. My doctor won't let me. I want to feel young again. Like I want to get my genome sequence done, make a peptide for me, and give me the shot. Like,
I'll be honest, guys. I don't have a lot of opinions on pharmaceutical drugs. With the exception of the GLP-1s, which I have read a lot about, I'm I'm not as knowledgeable when it comes to the other stuff, right? I think that's something that what's his name, Ken, is more in tune with, because Ken has become like a pharma bro.
Dude,
He's been doing well
he's
though.
full blown pharma, bro.
Yeah, he's gone full port pharma, man. So
I
he was
just,
telling us the best thing to ever happen to him was him getting laid off.
yeah, because listen, what I will say is he's super smart, but where he worked for the past God knows how long, he wasn't allowed to invest in individual companies because of all the restrictions. So he lost his passion for stocks.
Mm-hmm.
And when he got laid off, he had no restrictions and he just picked the most degen shit and went after it.
Yeah. You know, one thing that we should do a deep dive on, I think we did it already once. Verizon. People don't believe, people didn't understand the thesis behind Verizon. And
I'm a big fan of Verizon.
it's such an easy, like, I won't call it easy, but it's, if you understand the business cycle, you'll understand why Verizon is okay, let me rephrase. Verizon is good if you know what you're doing and how to play it. Otherwise, it's an okay stock, but it's not necessarily a compounder because they have very little top line growth. They are working on growing their top line, but it's not that great right now. So, yeah. Yeah.
We can do Verizon again on a Monday night. I mean, I think it's very interesting company.
Yeah. I mean, Verizon is a company that, like, during these moments of panic, people will jump into a company like Verizon because it's a utility. Telcos are a utility, you know.
Look, nobody's getting rid of their cell phones.
Yeah, and you get a nice 7% yield on the dividend. Come on, dividend's always growing. Their debt to EBITDA has gone down significantly, so now they have money for buybacks. They're laying 15,000 people off. I mean, they're becoming more efficient. They're growing. They're probably going to be growing their user base because of their fixed wireless access business, which is catering at, I think, like 20-30% a quarter right now. I mean, there's a lot of positives. They're finally done with their 5G build out, so now they can actually take that additional cash flow from debt repayments to share repurchases. I think what it is, people, me and you are value centric guys, so we look at companies from a value standpoint, and so sometimes we're not going to get you that 5x. You know, like the 5x is what everyone is looking for. Like, how come you guys can't find me a Ondas, the drone maker, and get me a 5x? You know, and I'm like, I'm not good at it.
Yeah, there's an easy reason for me. I don't look for those types of things because I don't like pre-revenue companies or things I don't understand, which is typically that type of stuff. Palantir was a much different situation, and SoFi was a much different situation. I'm not seeing those types of situations in the market. I'm really not. And I'm not going to take a flyer on a freaking art club. It's just not happening.
Yeah. Ondas was super. Yeah, Axon, I think I should have done more research on Axon before I put it into the ETF thing. I thought Axon was safe, but its valuation, after I looked at it, I was like, man, that's actually pretty high. So I was like,
$20
you owned Axon at 20? Jeez.
back in the day.
Yeah. What happened to Venture Global? When will it turn? Maybe that's one thing that we can talk about. I'll talk about that on Cash Flow Chronicles. You know, SMCI is free money. Maybe not. I don't know. Like, I just see a lot of data centers being built out, and SMCI helps a lot with that, but the market may not recognize it. And there's also this challenge with getting like, understanding the CEO is hard, man. It's really hard. I was trying to listen to his earnings call, and it was rough. We could listen to it really quickly and just, you tell me what you think. Hold on.
Who?
The CEO of SMCI, Charles
No,
Liang?
I refuse. I can't listen to him.
No, just for a minute, so everyone hears what he sounds like. So,
Put the link.
yeah, 1 second. Share
Put the link.
screen.
I don't want to get copyrighted too. I just don't want.
It's not going to get copyrighted on an earnings call. 1 second.
Like, it's
Here.
too difficult.
Here. Just put share the screen.
Today. At this time, to continue technology leadership in AI platforms, we are preparing for the Nvidia Aura Rubin, and then for advanced AI compute and infrastructure solutions is evolving rapidly. And Supermicro is uniquely positioned to lead with
This is one of those things that I would just read the transcript.
Value-driven solutions.
I would have to go back and listen to it.
Our data center.
Yeah.
I can't do it. Like, those are the types of earnings calls where it's just go read the transcript. You're just gonna need to read it once. I've look at SMCI again because a lot of people are losing faith in them.
I mean, the challenge is
again.
Yeah, that's because like they guided lower in the short term, and they have like a lot more growth coming in next year. So some people are saying, oh, they're done. You know, it's a low margin business too. So I don't know what I was thinking with these guys. This is not the traditional companies that I typically fixate over. But you see this, look, share the screen. You'll see why. Look at their growth rate. Their growth rate went from literally 39% all the way to 140, 54. And then the law of big numbers came in, and now they're down to 12%. And then if you look at their diluted EPS is also starting to go this way. See that?
Yep. So
not exactly inspiring in terms of where you want to be. EBITDA is, let's see. EBITDA is also declining. Look at that. Look at EBITDA. Now, if they reverse this,
where it should be accelerating,
right? You see, like the entire market going higher. Like, what the hell is going on? Like, why is it going this way? I'm saying, like, look, I could understand maybe a flat lines, but dude, it's going down. So, you know, one of the things I like about fiscal AI, let me see if I can ask it. Let's go to the research, actually investor relations. We can go here and ask AI summary. So this is like the summary for the second quarter. Right here. The company has raised this full year 2026 nail sales outlook to 36 billion, up from the prior guidance of 33 billion, expressing confidence in sequential growth throughout the year. So supposedly next year is going to be big for them. So gross margins are anticipated to decline by 300 basis points in Q2, primarily due to initial costs associated with ramping new mega scale GB300 racks. Let's see, a significant development is 1.5 revenue shift attributed to last-minute customer configuration upgrades, expanded volumes. Delay was impacting Q1 results. This is expected to bolster Q2 and reflect intrinsic nature of the business. All right, let's see if they're able to prove themselves. You know, historically commanding 300 core racks. All right, we'll see. We'll see, Mr. Liang, what you're able to do.
It's interesting.
Yeah. Dude, everywhere I look, I see these guys. So I'm like, how are you down? Just your gross margins are down how?
I don't follow them enough to know. I just know that they should be doing well next year with the amount that the amount that's going to be needed in the industry for infrastructure.
Hey, Chris, before you said you didn't like Neo Clouds, but saw you are looking at Cypher. Care to share? Yeah, it's their partnership with Google. I have to see I have to see how much the deal structure is, basically. So if you look at Cypher's like partnership with Google. Right here, Cypher mining stock is climbing. Google backs another data center. So I have to do more deep diving into this, but yeah, and not to mention Google took an equity stake in these guys. So I have to do more research. But if you have someone like Google taking equity ownership via warrants, it's not a bad sign. I think that the data center companies like Cypher and all of these guys, they're going to end up like commercial real estate. What do you think?
That's interesting. I don't know.
Because I mean, all these contracts are like long-term contracts. So
I mean, I went through the numbers. I like CoreWeave a lot.
Yeah.
At these levels. So I look at their debt, and look, I don't know what they're going to take out for debt next year, and I don't know what they're going to spend on Capex. But based on the cash on hand and their interest expenses and what they're losing and when they're expected to be profitable, they have a run rate to fund the business without issuing any equity from their cash on hand, which makes it very interesting to me. But these names, now that they've been chopped in half, start to look attractive again. If they didn't get chopped in half, I wouldn't even be looking.
I have to look at their equity like position and everything else, like how this whole deal structure plays out, because these things could end up being just like valued like a REIT in the future, because essentially that's what they are. They're just going to be landlords to the Googles of the world. So yeah, we'll see. Wolf is good at recycling parts. I don't know. I have to do more research. Bull trap is setting up again. Yeah, man, I have to do more research. I'm tired and I'm sleepy, so I'm gonna get some rest.
Yeah, I was gonna say I need to go eat dinner.
Yeah.
Then I will be back in 3.5 hours at 9:30 with Alex and Brian for Alternative Asset Weekly.
You're doing so much, man. Like, how many? By the way, just letting you know, Steven, and this is me saying this as your friend, you need to turn your monetization, like for ads, down. Like, you need to turn them down a good bit. Because, like, if you look at your comment section,
I don't even have it on.
Monetization,
it's not on right now. It's
not right
live.
Not when you're live, but when you're done with live, like Google makes
when I'm
it
done with live, whatever YouTube, I just have it set on the automatic thing.
I would turn it down only because, like, if you're watching, there's like people who get like ads every like 15, 20 minutes, like not even 15, 20 minutes, like really quickly. And the thing is, what that's going to do is that's going to dilute your growth, right? So you have to decide, like, okay, do I want less people watching ads or do I want more people signing up? And I would say let more people sign up and subscribe. And so turn down the number of ads, and you can control that from your Google monetization thing. And the other thing is invest in like some software, if you have software, where basically you can basically take this video and it will do all the timestamps. For some reason, people really, really like hate not having timestamps. So if you do the timestamps,
I was trying to write down when I switched topics of what I was talking about, but it's very hard to do that.
Yeah. What do you guys think in the chat? Is that a good piece of advice?
Is there software that does it automatically?
I don't know, because I'm not a creator. So I mean, you could ask like Tevis and Amit and all of these guys what they do, because they do timestamps,
Yeah,
and if there's
they write it down on a piece of paper and then they put it in the notes, and YouTube will automatically put it in.
Yeah, I mean, like I said, you are still at 10K viewers, so I mean 10K subs. So if you guys are watching, please go to the YouTube channel for Steven and subscribe. And he will turn ads down. I hope.
I'll figure it out.
You know, you monetize.
Ooh, look at this timestamp AI.
There's timestamp AI.
Timestamp AI.
If you can't pay for YouTube Premium, how can you invest? No, there's a lot of times where you're on a device that it's not linked to your YouTube Premium. There's a lot of times where I have my business account where I have my YouTube Premium, and then my computer, like my default username, that does not have YouTube Premium. So I'm like, do I really want to have my regular user premium and that one premium? So sometimes I'll just be like, whatever, I'll just skip the ad, you know. So, and a lot of people, you know what, they don't want to pay for YouTube Premium. I'm not gonna, you know, say everyone needs to get YouTube Premium. Some people, I don't know, they want to save that money and invest in Google stock so that they could one day get YouTube Premium. So,
all right, I found a website that has a YouTube integration. I'm going to look into it, and if this is legit, I will pay the monthly fee and I will hook it up.
See, there you go. Cool. That is cool. All you guys in the chat who've been asking about that stupid, what is it called? Like timestamp thing. I got your back. I have got your back.
Chris is going to get me to spend some money, which is fine. Timestamp AI.
It's a legit thing, timestamp AI. Let me see.
Yeah, timestamp AI. It's timestamps.videos. If you just put timestamp AI in Google, it'll be the first thing that comes up.
You might be able to do this for free on Gemini, by the way. So just double check.
You know what? You should be allowed. Gemini should automatically fucking do this.
Yeah, but we go into like 10 different tangents, bro. Gemini will probably get screwed up too. Yeah, AI timestamps for videos and podcasts. There's so many companies that are doing this. Yeah, it should be easy enough, man. All right, whatever. That's my input. So.
All right. Well, thanks, Chris, for coming on. I will see you tomorrow at 8. Everybody, thank you for being here. Chris and I will be live tomorrow at 8 p.m. going over Meta, maybe one other company. Please go follow Chris on X, and we'll see you tomorrow.
Jeez, man, look at this. That's a crazy comment, Peter. I'd rather drink toilet water than watch ads. That's woo. I don't know about that, bro.
All right.
I think we could end it there, right?
We're gonna end it there.
All right.
All right.
Later, guys.
See everyone later.